Well, wonderful. Welcome, everyone. Thank you for joining us. We're going to be discussing how you can get more funding and think like an investor. Learn from veteran founders and startup advisors, and really supporting and advocating small business to connect to capital, creative financing platforms, resources, mentors, and partners. So I really would we have the honor and pleasure of having both Carolyn and Mez here. And Mez joining us all the way from Australia in the middle of the night. So thank you so much. I just wanted to tell you a little bit about these amazing panelists that we have here today, and as well as introduce myself. My name is Faye Sahai. I'm the founding partner at Telosity Ventures, investing in early stage startups focused on digital wellness and mental health. And it's been such an interesting market. So excited to talk to these great founders and leaders here. Carolyn is co-founder and CEO of Hello Alice, a free platform that provides small business owners the tools, resource, and funding they need to grow, which is amazing to have her here, which I know so many of you are interested in. She's an investment banker turned three-time award-winning Latina entrepreneur from Bolivia. She serves as a co-founder and CEO of Hello, and really is looking as a Series B backed company on a mission to show that new majority owners, women, people of color, military affiliation, entrepreneurs with disability, LGBTQ, are all profitable, and you can bet on them in this entrepreneur space. This year, Hello Alice reached a milestone over 1 million entrepreneurs, representing all 50 states, and on the platform in which 90% are the new majority. During your time at Hello Alice, Carolyn has been recognized as 17 Women to Watch by Inc. magazine, named Hispanic CEO of the Year by Hispanic Chamber of Commerce, testified before the U.S. Congress House and Small Business Committee, and featured in the U.S. Senate report. She was selected by Mayor Turner of Houston to co-chair the Women and Minority Small Business Task Force in 2019. So Carolyn, welcome here. Amazing kind of hear your experience and background, and honored to have you here on the panel.
Thank you. Excited to be here.
Ms. is an award-winning technology entrepreneur, investor, and strategist for some of the world's most innovative companies, including QBE, Amex, Virgin, and several startups in Sydney and New York. Throughout her career, she's founded and led 2 startups to successful exits, raised over $50 million in investments, and increased the valuation for her clients by an average of 10x. Her latest venture, The Mad Ones, I love the name, is a unique venture studio that supports fun startups, scale-ups, and cooperation and corps in creating leading-edge user-centric products. Their signature program, High Level Founder, takes ambitious entrepreneurs from idea to trend analysis to validation to launch in just 90 days. A proud mama too, Mez is passionate about shifting the investment and work-life landscape for women by continuously investing in women-led startups. So welcome, Mez.
Thank you, Faye. And I feel like
you
should have done my intro first. I can't go after Carolyn. That was amazing. Hello, Alice sounds so incredible.
Well, you know, we love mad people too, so that's great.
We work together well. That's good.
Yeah. Well, I'd like to, each of you have such interesting backgrounds. And before we kind of start on all the questions, what's something you'd like to share with the audience? Your bios were amazing. I only took a snapshot of it. Is there anything else you'd like to share in such a dynamic market right now? Anything else you'd like to share before we go into formal questions? And please, for anyone joining, just introduce yourselves in the chat, ask your questions there as well.
Yeah, I'd love to hear from people listening in, like just a little bit about where you are with your own path, and just for a little context, it'd be helpful to help guide the conversation a bit. But I'll share just this path of entrepreneurship. I think having been on both the investor side and the entrepreneur side, and really spending most of my time, I'll say, on the entrepreneur side, it is so hard. It's so hard, and it's hard no matter who you are. It's hard no matter what you're trying to build. And the reality is, I think there's a lot of luck, but I do think it's really interesting. We've raised over $25 million at Hello Alice. And I think about now, I kind of look back at our first round of capital. This is the first company I've ever raised capital with. How different. I mean, I almost laugh sometimes when I think about us walking into those first meetings. I mean, we did some of our very first venture capital meetings on Sand Hill Road in Silicon Valley at firms like Sequoia and Andreessen Horowitz. and they probably laughed when we left the room. Like I think what we knew going into that process versus what we know now, you can see why there is this sort of pattern recognition among many investors, because the reality is once you know the lingo, once you sort of know the process, and once you have been through it, it's so much easier than when you've never done it before. So happy to share kind of just some of the lessons that we've learned along the way. But I think my perspective today versus my perspective 5 years ago is night and day.
Such a good point too. I've started 3 startups too, and it just the amount of lessons learned from that first to the third. And I think it's wonderful that you have a platform really giving and sharing those tools and resources and funding to that as well. So, I don't know, Mez, if you wanted to add anything else.
I was actually going to say if there's, I mean, to Carolyn's point, if there's any questions to be asking in the chat, but also I would love to know what level everyone is at and where they would be, what they're actually seeking at the moment, so that we can tailor the conversation a little bit more. But to my experience is very much mirroring a lot of what Carolyn said, in that you have to be patient. There's always going to be failures, as long as you can accept that there's the huge learning curve as you go through that. I think, you'll always get to where you want to get most of the time.
And Jenna, thanks for introducing yourself in the chat too. So Vital You, great to see that you established in 2018 and bootstrapped. Very common for especially women to be bootstrapping from this time, but really love that you're here, also asking questions too as well. And kind of if there's particular advice that you'd want in this area, because we all of us having kind of experienced both the founder as well as kind of the resourcing side, would love to help you in that. So we'll start off with some questions. Like, I think this is a wonderful one given Jenna too. When should an entrepreneur decide whether to bootstrap or fundraise? Let's start off with that question, since Jenna kind of kicked us off there. Carolyn, do you want to start it off?
Sure. I mean, I bootstrapped my first 2 companies, one of which failed, one of which I exited. So I've had very different journeys on the fully bootstrapping path. I'm here to tell you it does work, and I think you can build a company bootstrapping. At Hello Alice, we actually set out our first round. Our goal was to raise $3 million in capital. We had such a hard time raising at the time. This was back in 2017. We only ended up raising about $1 million and closed the round finally and decided just to keep building the company. And in hindsight, I'll say, I think because we had to be a little bit scrappier with our funds and stretch it a little bit further, we made much smarter decisions. And looking back, I think had we raised more, we would have spent it in ways that weren't necessarily that helpful and probably wasted a lot of money. So I think bootstrapping, I applaud you, Jenna, for bootstrapping, and for others that are doing it. I think it really stretches you to do more with less and to get some traction, to get creative with your money and learn your market and learn your business so well before you start raising. When you start seeing that traction, and for me, I always tell entrepreneurs, when you start seeing the traction and you need to put more money in to get more traction, but you already know the path forward, that's the time to put money forward. That's the time to go raise capital around those initiatives. If you're still trying to figure things out, I mean, you may need to raise, you may not be able to even test the market in certain businesses. You actually need to go raise some capital to test. But the more that you can test without the dollars, the better. It helps dilute yourself so much less. You're going to hold on to so much more equity in your business. But when you hit those sort of blockers and you're like, you just can't push through on the path that you need to without raising capital, and that capital is going to unlock a lot of growth, it's certainly it's been a really helpful path for us at Hello Alice, certainly.
Liz, do you want to add any more to that as well?
I agree. I wanted to preface it with, in my experience, it's not a one size fits all approach. Obviously, you have to customize it for the industry and where you're at. There's different industries that can't bootstrap, and some that can quite easily. But I do believe that I do tend to lean towards a preference towards bootstrapping until you have product market fit and you have that traction, like Carolyn was saying, and then you're taking it to a point where an investment would just accelerate that growth rather than create that growth. Because I do think there are skills that you learn like you said, Carolyn, that you can only really learn through that that bootstrapping phase, because a lot of the time you will be spending the invested money on the mistakes that you could have made bootstrapping, and which would have saved you a lot of time and effort. So I think you also are a little bit more limited when you get funding in the decision-making process and in the fluidity of where that kind of experimental phase of the business goes. And I know a lot of the time at early stage, we think we know where a business is going, but there is actually a lot of lessons that happen in those first years, 2 years, where if you can bootstrap, and I'm not sure if everyone knows what bootstrapping is, so maybe it's worth just defining bootstrapping as, self-funding from either your personal finances or the revenue from that business going back into it until you get to a point where you're asking for external funding. But yeah, my preference is always to bootstrap first before actually going to raise.
Yeah, and there are so many other channels. I think that's one of the things that we ended up like getting a ton of partners because we had to bridge that gap that we couldn't actually raise around. We ended up getting partnerships that was the same money that we ended up bringing in. It was just non-dilutive. It helped us grow tremendously, and those partners actually ended up evolving in many times into clients for us and customers that frankly helped us see the market in a totally different way.
Yeah, and no, sorry, Faye, you were saying?
No, go ahead.
No, I was saying it's a really good point that you're saying, because I think the skills that you learn at the beginning that you're forced to learn in bootstrapping, there are so many other avenues. Obviously, you've got traditional lending facilities, but also you're forced to be a little bit more resourceful because there are strategic partnerships, there are contra partnerships to get to your path that you need without having to get that investment first. So I think when I see an entrepreneur or a set of founders who are raising, who have bootstrapped for a few years and can prove product market fit and traction, I know that if I'm investing in that company, they're going to do phenomenal things because they've already got the skill set to be just exacerbating that with funding. Whereas if I don't see that, I'm not sure how that's going to take off with that funding. It's a little bit less confidence from an investor perspective.
No, that's great. We have this other question here for Veronica. I'm not sure if I'm pronouncing your. Hello, I have a company 5 years that she's been running it over $1 million in income this year, which is amazing. How does she calculate the amount for which she wants as far as her first investment? She hasn't asked for funding before.
Yeah, valuation at early stages is, I mean, it's so subjective is the reality with all of our we would put a valuation out there. Someone would tell us great or no. Like it's just sort of this back and forth of negotiation a little bit. Typically though, in each round, you're sort of expected, I think sort of market standard is that you're giving up about 25% equity with each round. So it's a lot often when you're going through that's trying to figure out what do you actually value 25% at. Again, it's quite subjective based on the growth of what does your business model look like and what does that growth look like over time. But the other sort of parameter is that you're looking at how are you getting to, at least around a 3x, growth rate before your next round of funding or before your next liquidity event, so that those early stage investors are actually making money for your future rounds. So you don't want to obviously evaluate yourself too high. You also don't want to go too low because then you're leaving equity on the table for somebody else that you're giving up. So it's sort of that balance of what feels right. But it's, I don't know, in my experience at least, we've always gone a little bit higher, I think, than probably the market would have said was okay. We always got investors. It was mostly early stages. It's mostly based on relationships. And our investors were like, either this is going to work or it's not. And if it works, what you're asking for evaluation is nothing. Like it doesn't matter. If it doesn't work, like we're out this money anyway. So what does it really matter? It's definitely more of I would say we had a lot of like very sophisticated investors that we were a small investment for them. I think sometimes angel investors are much more sensitive to that valuation and depending on what your investor base looks like.
Yeah. And I would also say that since you already have $1 million in income and kind of revenue from that, kind of multiples from that, and to Carolyn's point, you don't want to go too high or too low, right? Because that's your dilution and also your commitment. The market is very dynamic right now. So what we see happening is like during this past 2 years, there was quite a bit of high valuations. And for people that had maybe overshot, like as Carolyn was mentioning, if they overshot, they're going to have to their next one, if they don't hit those milestones, or they're going to go what's a down round, which is meaning their valuation will come down. From the original one. That's not a good place to be in, both for your investors as well as yourself from that standpoint. So that's why you don't want to overshoot from that. And so what we're seeing happening in the market right now, it does take a little longer to raise money right now because everyone's kind of watching the stock market, wondering about recession, looking at the interest rates, looking at their portfolio companies from that standpoint. So having that patience and persistence right now. And then like kind of your evaluation. What we're seeing is there is a lot of safe notes, convertible notes, which kind of throws the puck ahead, saying you don't have to do a formal valuation. So that's something you could consider for your first round, is doing a convertible note or safe, so that you don't have to go through a formal price round and valuation. So
I'm just reading her question. I'm just wondering, Veronica is actually asking how to calculate what to ask for the ask for how much she needs from an investor. So I would say after you've done the calculation on the valuation, you would basically be putting a financial projection goal, and then you would work backwards on that, on what you need to get to that projection, and that's how much you would ask from the investor. What equity is tied to that would be Carolyn's calculation that she just did. But more to Faye's point, at the moment, the market is a little bit conservative.
yeah. I'm wondering, since we have several questions on funding, what advice do you have for funding, and what type of funding is available? We kind of started to get into non-dilutive, dilutive, but I would love to kind of get both of your thoughts on that as well, on funding.
Yeah, Alice, on very, very early stage, kind of before you're ready for venture capital, what does that capital continuum look like, so that you can get to Mez's point, how do you actually get that traction and find product market fit and bridge that gap? So starting with grants, we use this with our own company too. There's a ton of grant funding out there. We've given away now over $40 million in grants at Hello Alice. We always have grant programs running, so you can check them out there. If you sign up for the newsletter, you'll get them sent to you and they pop up. But there's a lot of grant funding outside of us as well, certainly. The other piece, I mentioned partnerships. Look for strategic partnerships, ways that you can help others, because again, it doesn't take away any equity from your company, and it's additive to what you're doing. Credit cards, I know there's a lot of sensitivity around making sure you're using them responsibly and not taking on too much credit, but the reality is it does buy you 30 days of working capital to help bridge through some of those expenses. And then loans. I mean, the SBA has great lending programs that are out there. So certainly you can connect with your bank. We have a lending marketplace available at Hello Alice as well. They're all fair and equitable lenders. So you can check that out as an option. When you're ready for venture, I mean, it's again, making sure there's a lot of prep and it's a lot of time, and it certainly it's a full-time job in and of itself. I think I was lucky to have a co-founder who we kind of divided and conquered on the process. So one of us could run the business while the other one was jumping in on points of time in the capital raising process. But the reality is there's a lot beyond venture capital. So I would look at all your options and figure out which one is right for you and your business and your risk tolerance and the type of company that you're growing.
Yeah, I agree, because I think, if we're talking pre-seed, seed, Series A, that way, pre-seed, obviously you're still looking at things like crowdfunding as well. You're looking at things like grants, you're looking at friends and family investment, and the traditional lending facilities as well. And that is not marked by any sort of rev that you can put against that. And you basically be at idea stage for that. And then when you're going to sort of seed, that's when you're looking at angel investing, seed funding. I'm not sure for Telocity or Carolyn with Hello Alice, do you guys with pre-seed and seed funding that you do, is it predominantly pre-rev or of revenue already? Are the startups pre-rev
we
at
look
all?
for the companies that are established with operating revenue
Yeah.
primarily. Some of the grants are for pre-revenue companies, but for the most part, we're looking for businesses that have some degree of traction. But we're also very focused on kind of, I would say, more traditional Main Street small businesses, so they don't typically require as much startup capital as some other industries.
Yeah. Okay. Yeah. So that makes sense. So then you would be basically doing your own funding, bootstrapping. If there was any investment that you need, it's friends and family or it's traditional lending. And then you go to, once you've got that revenue coming in, so your post rev, even if it's a little bit, you're just showing proof of concept, right? Then you can start to raise from different areas and do crowdfunding, not just crowdfunding, but almost equity crowdfunding would work as well.
Great. No, those are wonderful, wonderful ideas. And then as you're looking at that, I especially love the non-dilutive funding in the very early, right? The grants, the strategic partnerships, opportunities, accelerators also offer kind of funding. The crowdfunding angels from that standpoint are great. And then we're seeing that from the venture capital side is it's great to see how much you will raise, that it's non-dilutive. We see that as positive. It's on your kind of your table as far as the capital you've raised as well, and you've kind of vetted your startup. So for us, it actually de-risks the situation because we know people have invested in you, and then it helps with your valuation as well. So it's a win-win in where we're going as well too. I put some of the links of the great companies and kind of suggestions here too as well, so you see that as well. Another question: how do you build up the traction needed to seek venture capital? Because we've been talking about the market fit, product fit, strategy. What is your advice for entrepreneurs and founders in that area?
Oh, experiment. We actually have an event coming up in January for those that are able to join, called Boost Camp. But we have a whole day around models for experimenting and iterating your business, so that you're building out your action plan and then figuring out how do you test against it. There's so many scrappy ways. I don't care what business line. People sometimes always, I get in debates with people a lot of times. They're like, my business is really expensive. It requires a lot of capital, but there are ways always. Very few businesses I found where you can't test without a lot of money, to just get really scrappy. I mean, we started Hello Alice, which is a huge tech platform with a lot of infrastructure and cost to build, certainly to get to the stage that we're at today. We have over 100 employees, 80% of which are engineers or product designers. And so it's expensive talent. But the reality is we started our first version as a virtual accelerator. And it was me and my co-founder, and we were pulling content and pulling on our own network and, setting things up in a WordPress site that we built ourselves. It was very, very, and even if we had outsourced the building of that website, it would have cost us less than $5,000 to do. It was super, super basic, but we built a community. We saw there was a need. It gave us enough to go out to partners. We hosted events. We did all kinds of things that were very inexpensive, actually helped us make money. So we got sponsorships for those events that we would put that money back into the business to help grow the technology. And little by little, we started chipping away and realizing what we learned in that process was that what we thought our business model was going to be was not at all, because we realized how cost conscious most business owners are. Not surprising. Everybody's trying to build their businesses, and entrepreneurs didn't want to spend money on anything. So areas that we thought they'd be willing to invest, they weren't. So we totally flipped our model and said, how do we build a business model that charges everybody who benefits when an entrepreneur succeeds, right? There's a million vendors out there that are trying to sell to them. There's, government benefits when small business succeeds. Who's already spending money invested in the success of business owners? Let's figure out how do we monetize off of them in a way that benefits the business owners. We don't want to be like just pushing transactions and marketing and being like a ad engine or anything, but it really made us think about a model that was very, very different. So now we make money on loan commissions, or we make money on when people have great programs, and how do we actually build the back end technology for the programs that they support entrepreneurs with, or how do we help match them to the right entrepreneur for a program? So there's lots of ways that we monetize that never touch the entrepreneurs. All of that's possible because we experimented and we tested, and we ran programs and did things without ever raising capital. So tons of different models for experimentation, but everything from setting up a booth at a farmer's market to doing $100 of ad spend and seeing which ad tests better, or putting 5 tweets out there and seeing which one does better. There's so many cheap and creative ways.
I agree. So I think, there's 2 different types of traction that you can show. It's the user traction, which will be the customer base. Then there's brand traction that you can build as well. And that all helps you set up for any sort of investment in the future. But it is a lot of test and learn, and it's a lot of product market fit validation. And there are, to Carolyn's point, so many different ways to do that. It's actually my favorite part about testing anything in products is just testing different business models. You're basically looking at what is the lowest fidelity version of the product that you want to test, and you keep testing until you get some sort of feedback loop that tells you that you're actually getting traction, and that's proof of it. But traction can be a lot of things. Traction also, if you're a very early stage, can be that you've got really good employees that want to work with you. You've got good engineers that want to sign up. You've got traction because you're showing that people want to join your team. You've got community building, to Carolyn's point. You've got people signing up for events. You've got a database. You've got an email list. Like that's all part of traction and building that traction. And the brand traction is also, what has this founder done to build their own brand authority in this industry? Do they have their own leverage with that? Is that part of that traction? And I think, that in this sort of social media world is very much part of it, depending on what industry you're in. But a lot of it that I'm in, we definitely look at that. If we invest in this founder who's also very active in this community and is also building their own sort of brand, and this brand, how fast will this compete against the competitors?
Yeah, no, all great.
Thinking a lot. I think it's so tempting in early stages to focus on scale of a product, but I really challenge everyone. I think it's something we didn't do enough of in the early days, but really focus on the quality of the experience. That if you have a really small group of people that love your product, it's much more valuable than a lot of people that have a mediocre experience with your product. So just think about how are you building that base of users or customers that love what you do, so much so that they're willing to tell somebody else about it, or they're coming back repeatedly. Really focus on that stickiness and engagement. Crack that code and then start thinking about scalability.
Yeah, I wanted to add to Carolyn's point, because we, as kind of venture capital, we're going to ask about your retention rate. We're going to ask about your referrals from that kind of quality. Some things that we've seen too is actually, if you do interviews or surveys of your target client and what they need, that might also then lead to a nice pilot with them, or a letter of interest. So they might not sign up because they're waiting for you to build some things, but they will sign up when, and so they actually write a little we're interested in this product and we'll sign up once it's launched. So that is helpful from the venture capital side as well. We're going to look at, if you're an app, what is your ratings, your social media followings. Another interesting one we've seen startups do is especially if they're looking to expand or different markets or products, they have wait lists. And the wait list kind of, it was really interesting. One had a wait list of 5,000 people, and they were deciding which cities to move to open next. And from their wait list that they naturally built from their website and where they were going, they said, wow, 3,000 of these people on the wait list are in this state. That's the next state we're going to do. So it actually helped them build in kind of their product. I know we have a few more questions here. So one, our company is based in Europe, but we offer services. Oops, questions coming in. We offer services also in the US. Do you think investors require the company be registered in US and it's not so important? Oh, that's a very good question. I can respond to that. It really depends on the investor. So some investors invest, globally, so it's not a problem. They also like some European startups and companies because the valuations are, from that standpoint, can be more beneficial for investors and kind of requiring some investors. And as you're looking at it, as we kind of look at the VC dollars kind of globally too, will want you to be registered in the US because there's not additional paperwork for them. They also want to have a close relationship with you. They want to kind of engage with you as well. So it really depends on the type of investors you're trying to target and address. I don't know, Carolyn, Mez, if you wanted to add anything to that too as well from your experience.
Yeah.
Oh, go ahead.
No, go for it. I mean, I'm already not in the US, so a lot of my fundraising has been from Dubai to London to Sydney to the States, right? It really does, to Faye's point, depend on the investor. Some investors are maybe more focused on pre-seed, and I found that a lot of pre-seed doesn't want to go too international. But it really does depend on who you approach. In my experience, it's been really hit or miss depending on where you are. But yeah, I'm not sure, Carolyn, your experience.
Yeah, ours have been, I mean, all over the place, frankly. I think when we first started, there were a lot of investors. Faye, I'm curious from your perspective, but there were a lot of California investors that only wanted to invest in California. I think that's changed so much since then because there's so much competition now. So our investor base now they invest internationally. One of our first angel investors, ironically, Mess is actually out of Australia. So a great investor who's stuck with us all the way through every round since. But I think I found so much it was more relationship based versus geography based. Every investor that we had, particularly in the early days, even in later days, it's been like someone's referred us to an investor and we've had an introduction and kind of a warm intro. It's very hard, I think, to show up cold. Somebody doesn't know you. There's not a lot of trust there. If someone's going to give you money, there has to be a high degree of trust and confidence in your capabilities as a founder. And so I think building those relationships wherever and however you can, taking the time to do it, showing up, even if you just had an initial meeting and didn't go anywhere, keep in touch, keep sending updates, let them know how your company's growing and evolving. Our lead investor for our seed round initially told us no. We just kept sending updates and updates and updates, and came back a year later and they said, yes, like, this is great. You guys have done a lot. You've delivered on a ton. Same thing for the SVB Capital, Silicon Valley Bank, led our Series A. Same thing. They were like, and then they came back a year later and ended up leading our Series A. QED Capital, who led our Series B, our first conversation went nowhere, but months later, when we were actually in a capital raise, they ended up investing. So I think relationship more than geography is my advice there.
That's actually, Carolyn, something that I put. It's the only thing that I wrote down to speak about in this panel conversation, where I was saying if I could leave it with anyone, it's that start building those relationships early. It doesn't even have to be when you are raising, but it's building those relationships, because it is very difficult to go to someone cold and there won't be that sort of a kind of familiarity with you. And I think as an investor, you kind of want to see how that's grown. You want to see that, oh, this person's turning around those lessons really quickly. And, there is something that, you become a little bit more emotionally invested, at least for me, into that journey. And so I think from my perspective with success, regardless of geography, it really is how well you manage and foster those relationships and start them early.
Oh, yeah, I would totally agree with both of you on that too. Like we have relationships with startups for over years, and whether we invest or don't invest, we're also here to kind of help support the community. But agree, send quarterly updates, build that trust, research. So if you're preparing to speak to a venture capital and you say you're preparing to speak to me and pitch to me, and you might not, you just want to build a relationship, research what I've been investing in. What am I posting on social media? What stage is my venture capital? So if you know that our sweet spot is seed and you're like nowhere near that, then it's like we're not, know that and understand that I'm investing in digital wellness and mental health, and this is kind of the areas. And be prepared, because that homework will pay off. And investor relationship, do as much due diligence on the investor as they are doing on you, because it's like a marriage you can't get out of very easily once you accept money from someone. So you want to make sure you're aligned on expectations and kind of thoughts from that standpoint. Yeah,
I think it was really eye-opening to me realizing, I feel like what everything sort of turned was realizing investors are in the same boat as entrepreneurs. Like they're out raising capital. They have metrics that they have to report to. Like they're running a business just the same way that the entrepreneur is running a business. And I think when you start to sort of walk into the meeting, like, look, this is a great opportunity. This is a win for both of us. Like we're going to walk into this. We both want this company to grow. Here's our plan. Here's how we're going to take this company from A to Z. And then you're showing accountability towards that plan, that every week, because even the fundraising process, even if an investor is on a path to yes, it takes months oftentimes by the time you have that first meeting and the time you actually close. So updating them every week with every win, with every, whether it's, oh my God, we just got this great new employee that we're so excited about, or we landed this huge new client that's going to be huge for us, or we're getting this press opportunity that we're really fired up about. Those little wins start to add up and show that like you are on your game and you're a good investment and you're going to help put them in a good light. I mean, other than angel investors where it's their own money, but the majority of investors are, they have LPs that they're working for, that they're supporting. And so I think when you start to look at that model, it just sort of shifts the way that you walk into the meeting and how you're presenting your business to them.
And you can
I was no, I was you go, Faye. No. I was just about to agree with you. I was going to say with what you said before, it is also you want people who are aligned with your values, and not all investors are the same, right? Some you might want an investor that's just investing money and has no specialty in your industry and no sort of mentorship. Some investors actually have backgrounds in health or backgrounds in anything that could be beneficial. They can also guide you, and you won't actually know that unless you build that relationship before you go.
Yeah, and then so you're giving this update, as Carolyn was saying, your regular updates, your progress, where you're going. Include your ask, and not the ask doesn't always need to be money. It might be like, does anyone have a subject matter expert in reimbursement coding, or we're looking to expand our advisory board, or we are targeting this customer or client group. So you can include those asks too, because you never know from that. Everyone knows someone from that. So when you're sending out the broad updates to all the funders you've talked to, that's a great one. Jenna had a question here. She would love to know a bit more about the avenues for funding, such as using sites such as WeFunder, Kickstarter, or finding VCs, and the pros and cons of doing so. Who wants to start off with that one?
Correct me if I'm wrong, but Kickstarter is not crowdfunding, not equity crowdfunding, right? I don't know about WeFunder, but so there's different crowdfunding versions, Jenna. There's Kickstarter, which is, you're investing in a company and you get the first of their product or something. You get some sort of gift as a result of it. And then there's the equity crowdfunding, where it's basically diversifying. So you're getting like a huge crowd to invest in a percentage of the equity, as it kind of is self-explanatory with the title. But for me, I would say the main thing is it's probably a little bit easier to get equity crowdfunding from a VC. So if you wanted more immediate cash, you could probably go that route. And it might be a little bit more entrepreneur friendly versus VCs as you learn how to approach VCs. But that would be mine off the bat. I don't know, Carolyn and Faye, what you guys think.
I would say unless you are a master marketer, stay away from crowdfunding. I think it's great for people who are great at marketing, but it is I've never done it, but I know a lot of people who have. It is a lot of time and energy and effort. And also, again, I think similarly to raising venture capital, a full-time job. If you think you're better, your financials measure up, you're really good on the technical aspects of your company, you're good in a one-on-one scenario, I'd say go VC. If you're great on the marketing front, maybe not as technical and you can paint a broad picture and kind of put it in a good marketing light, equity crowdfunding might be great. I think you have to have both for both audiences ideally, but that's, if you were to choose, I would kind of figure out where your strengths lie as a founder.
It's really interesting, actually. I have two founders who are in their 5th year of business. They maybe turn over 7 million a year. And they've just completed their 3rd equity crowdfunding. They've never raised proper funding. I thought it was such an interesting route to take. But my perspective I was very similar to what you just said, but my perspective kind of changed with them. But like you said, they do have, it's a physical product. and it's very aesthetically driven. So maybe it kind of sells itself a little bit with their marketing. Their marketing is good. But I do think it is a lot of, I mean, both of them have a lot of selling, but to Carolyn's point, if you're going equity crowdfunding, you're kind of selling B2C directly. Like you're already in this needing to convert a user. Whereas if you go to VC, you're selling the idea and the concept of the business more.
Yeah. And then I would say that too, like with the Kickstarters where it's not equity and it is a product, a physical product that can be shipped with it. It is like from our side, if we say like, wow, you did a Kickstarter and, you know, within the first month you had sold blank number of products from that and the kind of demand, it kind of shows kind of interesting traction, right? Like
Yes, product
especially
market
the
fit.
data from
Yeah.
a product market fit. So that's kind of an
Yeah.
interesting way.
point.
And Jenna, to your finding VCs, which is a wonderful question from that. So your LinkedIn's basically Crunchbase, PitchBook. You can actually find the VCs and what they've invested in from that standpoint. So those are wonderful kind of databases. Crunchbase is, you know, a lot easier and more affordable to kind of search in. You'll actually see that who the contacts are, their portfolio, who they invest in, and kind of pros and cons. There's also a lot of kind of conferences. I have a debate with my fellow VCs, like, you know, where they hang out. You know, some are like the Twitter fans, and I'm more the LinkedIn fan. So from that, you'll kind of see that there's a lot of conferences. I think pitch events, just like what we have here in Women Future and other pitch events too. You know, we're attending that and kind of monitoring what's coming out from those as well. So accelerators, incubators, you know, we're also partnered with them as well. So
I was going to say you have three right here, and every investor knows other investors, and so it's a great opportunity to like start to build that sort of web of connections. And then I always find other entrepreneurs, I think, are great resources. If you get on Crunchbase and find out, to Faye's point, who else, you know, if you find an investor who looks interesting, they're investing in similar companies, I wouldn't make the first point of contact necessarily the investor, because it's very hard to go in super cold. But if you make the first point of contact an entrepreneur, they're all in the same boat. Like they were where you were once. And I think there's a lot of, I mean, investors too, I think there's definitely a very like communal aspect to it, but they're getting hit up a lot, and a lot of people are asking for money, and there's limited money to give. Finding that gateway through a fellow entrepreneur and saying, look, like, what was the process like? How did you get introduced? What was the first meeting like? What were the questions they asked? You now have a lot of context going into that initial meeting. And then you can start to kind of work that web. It may not be the first entrepreneur you talk to, but if you contact 5 or 10 of their portfolio companies, surely one is going to bite, and it's a great path in.
Yeah. I did wanted to say too, an interesting one as you're starting to share your decks or your one pagers out to people. I do recommend kind of having it, whether it's DocSend or something else, to see you send it as a link, because then you know they've opened it, and it also gives you data of like which page they spent time on, how much time, and it becomes very interesting, a feedback loop for you, right? Like if they're spending a lot of time on your business model, but not on this page, you know, like, do I need to, you know, those are the ones that are more important. Should I put that one earlier? Should I adjust it from that? And DocSend does some really interesting research as well on what investors are looking at, what are the important slides to look at, and they actually have quite a bit of research on that they publish every year. So definitely, and I can put that link in the chat later if people are interested in that. Jaylen's had a question. She's a current MBA student at North Carolina State University. Her current role is a consultant and CFO of a startup, and it is pretty much challenging and has a lot of ambiguity. Definitely agree. Early stage startup for a CFO is very challenging. What advice do you give towards a startup entering into an industry where there's much more risk than other industries?
Do you want to go, Carolyn? I feel like
I was going to say, you have to have a lot of risk tolerance for sure.
Yeah.
Startup,
resilience.
Any startup is a total crapshoot at the end of the day. I mean, I think there's so many things that there's certainly great opportunity, but there's also a lot of things that can go wrong, both within the company's control and beyond the company's control. I think if we've learned anything over the past couple of years, it's certainly that you just never know what to expect. So I think one is really assess, is that the career that you want to lead. And I think we found early on that we had employees that thrived in that environment, and we had employees that really disliked that environment and were great in, not necessarily they couldn't go work for a startup, but they needed a more established startup than the phase that we were at. As we've evolved as a company, we also found people that thrived in that early stage scrappiness may not necessarily be the people that were right as we grew and got more process oriented and more established as a company. And so I think really figuring out where your lane is and what you love, figure out the spot. It may be that early, really early phase, like we're pre-seed or seed stage, is a little too risky. A series, A or B or C, there is a lot of that entrepreneurial spirit, but it's not quite as high risk. I mean, I think by a series B, for the most part, like you've pretty significantly de-risked. The company's probably not going to blow up overnight. Whereas seed stage, you're often, it can be, you're working on sort of months of runway sometimes, which can be very, very tight.
Yeah, just to add to that too, because I've worked in heavily regulated like healthcare, insurance, financial institutions with quite a bit of risk too, is get advisors from those industries. Figure out a way to do risk mitigation. And one is just getting experts in that area and saying, can you give us advice? What are your thoughts in this area? Ask if they'll join. Because as we're looking at it, if you have really strong advisors from that, we're like, oh, this is actually helping supplement your team. You might have some gaps in your team and also helping mitigate some of that risk. And please feel free. I love all the questions and comments, so keep those going in chat. One question I wanted to ask is, how can you take some of those big business funding strategies and adapt them for entrepreneurs? Both of you have worked at kind of big companies, worked and partnered with big companies. Are there some of those? And I know we have some companies online too as well, so with us.
The question was taking big business strategies and adapting to a startup?
Entrepreneurs, yeah.
Because I feel like I feel like the big business needs more startup thinking. So when I work with big business, it is very frustrating for me because the pace at which they execute is very slow. So as far as big business, I think it's probably more, I guess, setting up revenue models and operations. So operations is a very big business thing. And I think at a startup level, when you're very young, you're kind of creating a business and you're doing everything and you get kind of capped at a certain rev amount because you don't have the operational framework to scale yet. And I think if you're going to take anything from big business, it's probably the level of structure and framework around operations. Outside of that, I think big business could use a lot of startup insights. But Carolyn, you tell me your thoughts.
I think scoping and being reasonable about what you're trying to accomplish. I mean, we have always struggled. I think probably the number one struggle at our company, and part of me loves this, but I do think it's something that probably would get the most pushback from our team about, is getting more focused and just being reasonable about what we can accomplish. I mean, both my co-founder and I are quite visionary in terms of there's a lot that we want to do. We get excited and it puts a lot of stress, I think, on the team, and with a really lean team, even more so. And so making sure that you're being realistic about what a project entails. I think so many times we're like, okay, this makes sense. We have a really scrappy way to do it, but what we don't necessarily have as much of a lens into until we get deeper into the project is operationally, what does it take to maintain and sustain that business line? And so thinking through, I think sometimes slowing down actually helps you do it a little bit smarter. When you're sort of saying yes to everything and taking in everything and jumping at every opportunity, it can put the team in like a little bit of a tailspin. And I think focus, the ability to say no. I mean, I think that's the corporate sort of slowness. There's times for it. It's not, I agree with Mez entirely. I'm like, it's painfully slow for me, and I love the speed, and I love it sort of thrive in the excitement of a startup and of a growth, like high growth company. But scoping, spending a lot. I think where you do have to be slow is the scoping of a project. Really thinking through, what does this take? How are you building it? How are you planning it? What does the financial model behind it look like? And then pausing after that beta period again to like assess what's actually been done. What is reality telling you? How are you adapting? And then how are you going to resource for sustainability?
Yeah, no, I agree. I ran kind of the innovation for both AIG and Kaiser Permanente, and partnering with startups and trying to basically accelerate kind of the big mothership from that standpoint. But there are really interesting ones. What we've seen, in, especially in historical downturns of venture capital, is increases in corporate venture capital. So what happened is these companies actually need to partner, to Mez's point, with startups. So they actually create their own venture capital funds. And that's also another interesting way as far as strategic partnerships that Carolyn was mentioning is you could actually partner with a corporation, pilot with them, and also possibly get investment from them. What's interesting with these companies is then they become not only a strategic partner, maybe a distribution channel, a reference client, as well as an investor. So that's kind of an interesting part in that. And they're also then kind of like a reference point of like, oh, that company invested in you. So that is good from that standpoint. But yes, really looking
Really
at
good
it from
point.
strategic partnership standpoint as well. And Ness, thank you so much for your validation guide. Do you want to, you put that link in there? Do you want to?
I realized you were putting stuff, and I realized we were close to the end of the session. So I was cognizant of that, and I thought, oh, what can we give people? So this is just a product validation. My background, just so everyone knows, is products, so head of products. So I just love innovation and how users will think or customers will think to do that, and that's how they use a product, how they go about doing stuff. And my background's psychology before that, so kind of tied that into my validation. So there's some validation tips, much to Carolyn's point, that about, creating a landing page for signups or ads or any of that. So I thought I'd just slop that in there in case anybody wants it.
No, that was wonderful. I also put in our market guide that was for investors and entrepreneurs. It also has pitch tips, resources, things like that as well. And I know, and a reminder that the pitch competition is coming up after this session as well. And Carolyn, thank you. I was just going to say, please include yours. Do you want to talk about your workshop coming up?
Sure. I know we talked about experimentation and iteration. And so for those interested, signups actually open up next week. So if you just sign up for the newsletter, you'll be among the first to hear about it. But it's a super fun kind of 3-day cohort base. We've got some awesome speakers like Whitney Wolf-Hurd from Bumble, or Sally Krawcheck from Ellevest, Alan Jones, the CEO of Bambi. A really great lineup of speakers. So if you're interested, come check it out.
Oh, wonderful. And I know we just have a couple minutes left as well. What is your kind of, ending kind of advice, kind of closing advice as we're kind of closing this roundup?
My advice is, I don't know where everyone is in this sort of journey of their business, but constantly experimenting and learning from those experiments is probably the most important thing, which is why I'm obsessed with validation. And I don't think it's just at the beginning. I think, there's that mindset of being in constant beta. And I think that's something that I take no matter what stage of the company that I'm at, whether it's corporate, whether it's large, whether it's a startup. It's how do I put myself in a mindset of constant beta where I can constantly test with customers and users and business models. And I think if you have that mindset, as long as you don't get stuck in an analysis paralysis, you're probably going to do pretty well. You'll find successes in that.
That's great advice. I mean, mine would be just trusting your gut. I think you hear so much from so many people, and particularly as you're out fundraising, you're going to get a lot of advice from people who honestly, like, anybody on the outside knows very little about your business and in the weeds. And there's a lot to take in and process it and take it in, but also like, you're the founder of your business and you know the type of company that you want to grow. So take it in, process it, but like nobody knows your business like you. And I think at any stage of your business, you have to always sort of you're taking in, but I think as a founder, your job is to process and synthesize that and choose the direction forward.
Oh, all great tips from that as well. And so I'm so excited for all of this. Then I just wanted to reiterate the other one that we talked about earlier. It's relationships with your team, your customers, your investors on that, and kind of continue to grow, and kind of your advisory group as well. So thank you so much for speaking here. Thank you for all the attendees that are coming. Thanks for the conference. Great to have you all here. Hope you have a wonderful time. Thank you again for Rusalana, our conference organizer. It was amazing support for us, and hope you have a wonderful time. Thanks again to all our panelists, speakers.
Thanks for being a great moderator, Faye. And Mez, thanks for waking up in the middle of the night for us.
I know, Mez. You look amazing for the middle of night in Australia.
Thank you. I've got a huge ring light here, so hopefully it's
I was going to say, you can see my room getting darker as we've been talking. So
thank you both.